树冲人一箩，有人问你风那样吗？啊，怪罗，你说你要找。
Happy Sunday, everyone, and welcome to the Macro Sunday podcast. I'm Andreas Steno, founder and CEO of Steno Research. And remember that this is your independent macro podcast out each and every Sunday all year round. And today I'm joined, as per usual, by Butthead.
Back in the sauna here. Yeah, thank you.
I referred to a comment that we received in the inbox, and I think on YouTube as well, from last week's show. Someone watching it writing to us, Beavis and Butthead hosted Michael Cow. So maybe we should just label
spot on, really.
You're Butthead, I'm Beavis.
Fair enough. I'll take it.
But today we're going to dig a bit deeper into the sort of structural issues in China and we'll take a, say, 10 to 20 year look at the growth model in China with a guy in the know, so to speak, Tony Nash, former director of the Economist Intelligence Unit in Asia, but also with experience directly from the bureaucracy in Beijing. So a guy who knows what he's talking about for once about China.
Yeah. In contrast to every pundit on the news at the moment, huh?
Yeah, more or less. Yeah. But enough about China for now. Emil, we'll talk to Tony in 10 minutes' time.
Yeah.
Because around our neck of the woods, we've seen recessionary vibes coming out of right about every print this week. I'm talking about Germany now. And before we talk about the potential for a German recession, I'd like to start with a small soundbite from a Volkswagen commercial.
Hey Darcy, look. 100,000 miles.
So?
It's a big deal. What if I told you that every time a Volkswagen hits 100,000 miles, a German engineer gets his wings?
Dooby-dooby-doo. 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 Dooby-dooby-doo.
I hate these wingy thingies.
Yeah, Dad, and I'm sure at 200,000 miles, rainbows shoot out of their butts.
I urge you to go watch a top 10 of the best Volkswagen commercials on YouTube. They've actually made quite a few funny commercials.
And we're not sponsored by them.
No, sure. Even though you're not driving a Volkswagen either, right? No, I'm not either.
No.
They may be the co-owner of the car. I know. Never mind.
Well.
I drive German anyway. But Emil, the reason why I wanted to play this sound bite from a Volkswagen commercial is that the German economy is not doing well, and in particular, the auto industry is not doing well. So take us through the numbers that we've received from the German economy this week.
Yeah, well, we got the PMI numbers, which were, well, as we expected, atrocious, but perhaps even worse than we thought we would. We have, something that I note, which is basically taking place across the continent at the moment, is that I think services are really getting some headwinds here. And I think that's sort of the domino that's going to kickstart the weakness in the labor market. So, we have, Eurozone, GDP, Q3, I think we're tinkling about maybe minus 0.2, 0.3 in real terms. So
not a catastrophe, but not good.
No, but when you take all the other signals into account and the current activities levels, I think, I'll go out on a limb. We're going to see a recession in Europe to the extent that we already are, even if you take that in.
Yeah.
So that's problematic.
Manufacturing PMI is still sub 40. That's not really new to Germany. At least we've seen numbers like that since the energy crisis of last year. Now the service sector is sub 47 as far as I remember. So also in recession territory. And it is kind of a trend we see across most of the continent, and obviously when the service sector, drops into contraction territory, the composite PMI drops into contraction territory as well. I'd like to get your take because we actually went briefly below 50 during the autumn of last year, also in services. So is this a true recession signal when it was not a true recession signal in Q3, Q4 last year? What's the difference here?
So I think hard data right now is coming in quick, and it's not looking particularly good. You look at truck mileage. You look at consumption, retail spending, that sort of thing. It's all pointing one way. So I think that's the big difference from last year, and well, obviously we had a bit of a revive here in H1 in 2023. I think that's running on fumes, obviously.
Emil, how much of this is directly linked to the malaise in China? I mean, we had a look through the week on like the interconnectivity of the European economy and the Chinese economy, and just to throw a number out there, roughly 10% of Euro area exports reach China. So it is a biggie when China catches, when China sneezes. Sorry.
Oh, it's massive, and that's a GDP terms, just to get that straight. But it's also skewed, and I think that's one of the things here, right? So, what are the Chinese buying and from where? They're buying German cars usually. Now they've stopped doing so. So now you have like the perfect storm sort of hitting the German manufacturing sector, right? So you increased cost base on basically everything from energy to labor, and weakening demand. That's just going from bad to worse. So it's I'm afraid I don't have that much positive to say if we talk about Europe. And
then let's move to China. Emil, I've noted how the market sort of trades in conjunction with positivity or negativity around the yuan right now. So every time we reach levels above 730 in dollar yuan, it seems like markets sell off. And when the PBoC manages to push down the exchange rate again in dollar yuan terms below 730, it seems like the market sentiment improves a little bit. Does that make sense to you? Or
it does. The thing is, usually that 730 line is the front line of defense whenever they're in trouble, and that's what they have been defending. So we don't have that much data above it. That's one thing.
42 observations to be extremely clear.
But really, I think it's just a gauge for nerves in a sense, right? I mean,
sentiment overall.
Sentiment. People are going to sell off the denominated assets and what have you, and just if a major central bank starts to lose credibility, that's just everyone runs for the door. So there you are.
To take a few numbers on this, and you're right that the data sample is relatively small. But average returns in S&P 500 on days where dollar CNH or dollar CNY trades above 730 is 0.5 minus. So negative returns on such days, and we have positive returns on days where the dollar CNH trades below 730 on average. But I find the sort of relative return outlook for various sectors quite interesting in relation to this 730 discussion, because on the days where we've traded above 730, we've seen an extreme performance in energy. And I'm not sure that it makes sense entirely, other than due to the fact that energy is, of course, an important component in the inflation basket in the US. And when energy rallies, there's a tendency for spreads between dollar and yuan to widen, which may be the reason why we see this pattern with very strong energy performance when there is a pressure on the yuan.
Yeah, I think that's one thing. Another thing is if the Chinese yuan is generally weak, that might be due to simple import price pressures, right?
Yeah.
So they try to accommodate to it. So, and what do they import? Well, food and energy,
Yeah.
essentially. So I think that's the other part of that equation. But yeah, it's interesting. Perhaps also there's some sort of sentiment movement within the equity sectors, right? If there's trouble ahead, why wouldn't you hide in hard assets, so to speak? Right?
Yeah.
That actually generate some cash flow. So,
yeah. But the evidence, even though the data sample is relatively small, is pretty clear.
Yeah.
Energy, industrials, and value basically outperform anything that we millennials typically buy in equity space. Teslas, what have you?
The Charlie Munger
technology.
trade. Yeah.
Yeah, exactly. So we'll go with the boomers still here. I think that's at least that's the conclusion based on this relatively small data sample. Just to be clear again. Mm-hmm. But Emil, before we invite Tony Nash to join us here, it may be worthwhile taking sort of a look at the Chinese growth model and what worked for them over the past couple of decades here. I think it's safe to say that parts of this growth journey was driven by real estate.
Yeah.
So what is the Chinese growth model right now, and are they about to change it?
Well, that's the big question. Well, up until now, the growth model has basically been utilizing market forces to help you achieve your outcomes, which are centrally planned.
Yeah.
And you use that. They have very much been reliant on investments and investment targets and exports. Those are the two components in the GDP growth model, right? So you have ghost cities now, and you have bridges to nowhere and all that stuff. But that sort of accumulated when we reached a place in the economy where it couldn't really absorb any more productive investment. And we've been on that path for quite a while, and now it seems the ghosts are coming out from the closets and sort of coming back to haunt them here, because unfortunately they have acquired a massive amount of debt to service all that investment. So that's the juncture we're at the moment.
It is, and I think we'll allow Tony to answer the question whether the Chinese growth model is about to change. Tony's got tremendous experience both from Singapore, Beijing, and other countries in Asia.
Yeah.
So obviously a guy who knows what he's talking about when it comes to the centrally planned economy in China. And as per usual, we'll introduce Tony with a piece of music related to China. To introduce Tony Nash to the Macro Sunday podcast. Tony is the CEO and founder of Complete Intelligence, and also the former director of the Economist Intelligence Unit in Asia, among other things. You have many years of experience in Asia and in China, Tony. So great to see you. Thank you very much for joining our show.
Thank you, Andres. It's a real honor to be here.
Tony, one of the things I've said many times in media appearances when I've discussed China is that most people watching various finance shows in the US should be aware that many of the pundits discussing China have never been there. You've actually been there, you've worked there. So I'd like to start with a discussion on the Chinese growth model and how the whole model with the Politburo sort of trying to design an economic model works. So, Tony, how centrally planned is this economy in practice in China?
Sure, it's a great question, and thanks for having me. The Chinese economy is a centrally planned economy. You have pockets of and they're not small pockets. You have pockets of real, pretty open markets in Shanghai, Beijing, the places where a lot of the foreigners go. There's a lot of open market activity there. And what I'm saying isn't to take away from that, because there are some real entrepreneurs in China who are fantastic. But the Chinese economy overall is a very centrally planned economy. Under Xi Jinping, that has become more so. I think that had been a bit decentralized over time. But when Xi Jinping came in 2012, one of the first things he did with Li Keqiang was dispatch people from the Central Audit Bureau out to the provinces. And that was intended to look at statistical reporting to the central authorities at the National Bureau of Statistics. But really, what I believe in hindsight is that was really to understand what was going on in those provinces so they could better control the activities in those provinces, because things had kind of gotten really decentralized over the previous two governments. So you have major organs of the government. I'm sure you guys have seen Commanding Heights, which was out 30 years ago or something. And you do have these major organs, from the transmission mechanisms in banks to export import, say the port facilities, to steel manufacturers, and on and on and on. There are all of these central government controlled organizations that are at key bottlenecks in the economy. And that's really how things are controlled. You've also had these government finance facilities, LGFVs, local government finance vehicles, that sprung up over the last, say, 15 years or something. And those are becoming increasingly centrally controlled because they can't manage their debt. And so how is the central government regaining control over commerce? It's through management of debt. And so, the central government, which controls the banking system, has worked with the transmission mechanism in the banks to roll over debt continually since about 2007. And it's only through that debt management that a lot of these organizations, we'll call them companies loosely, but a lot of these organizations can survive. And so that is how a lot of that central planning and central control is really exercised.
So, Tony, when a gross domestic target is set at, for example, 5%, as is the case for 2023, how's that orchestrated? And the target is centrally planned, but what about the actual exercise of the plan in the economy?
Well, you have to look at things like, for this year, you have to look at things like how foreign direct investment has just collapsed in China, right? I mean, these are some of the obvious things that you look at to say, is 5+% even possible? It's not, okay? You also have to look at, so that's kind of one of the, obvious factors. You have to look at imports and exports, which are really declining, and that's a major factor. You also have to look at things which, and this is not a China-specific issue, this is every country. You have to look at things like the total factor productivity variable within, national income accounting. TFP is a fiction in every country. There is no country on earth that has an actual total factor productivity value. In China, it's ratcheted up and ratcheted down based upon where they need the number to be. Okay. And to be honest, this happens everywhere. TFP is a residual, but it's a major factor ish within national income accounts. So, there are a number of ways that China can play. I think the economic authorities are in a very difficult position this year for a number of reasons. They have so much of an issue with debt that they're having to devalue in a controlled way, devalue CNY in a controlled way, so that they can raise their export income, their CNY denominated export income, meaning, that comes in dollars, but then they convert it to CNY, right? And they can then use that CNY at a devalued rate to keep their debt alive, right? So, and all of this goes back to some basic principles in China, is there really isn't kind of a Western form of bankruptcy there. Okay. In a centrally planned state, it's a very different. It's more insolvency, which is kind of the same, but it's different. So if there was a bankruptcy release mechanism within China, you could have a lot of this debt kind of dissolve like we do in the West, right? But it's just not possible in China.
So, Tony, when we look at the Chinese growth model, it's been at least partially reliant on construction activity and the real estate sector. And we know that the Chinese demographics look outright abysmal 20, 30 years ahead. So obviously they need to change the course somewhat on this construction sector. How do you view this real estate conundrum in China and the structural outlook for the debt related to that sector?
Yeah, I think for real estate itself, obviously it's core. Real estate is core in every country. And part of the problem with China is there's this very... I wouldn't say it's explicit, but it's almost explicit social contract of, hey, we're in an autocratic state. So if you behave, people of China, and there isn't social unrest, we will continue to raise your standard of living. And that's basic. And, you would hope that that's the case in every country. But I think in the West, it's a little bit looser, right? I mean, you have good years and bad years, and people go bankrupt and people have difficulties and this sort of thing in kind of freer economies. In China, there is an expectation, since things are centrally planned, that the standard of living will continue to rise. And one way that was done has been through real estate investment. Because if you're in China, where can you invest? You can invest in Chinese stocks. You can invest in wealth management vehicles, which are super sketchy. You can invest in real estate, which is very, very tangible, right? And in Asia, there is generally a connection to real estate because the economic cycles in Asia are way up and way down, right? So if you invest in stocks, it's kind of an intangible. So it's nice when you can get it, and it's nice when it's doing well, but it evaporates, okay? And the perception is that real estate is at least tangible. It's something that you can get something out of if everything goes belly up. Not necessarily true, but that is a perception, right? And so we've had real estate boom dramatically over the last, 20, 30 years, of course, right? And so that's accelerated and accelerated and accelerated. And it creates an expectation within the Chinese people that their house price will continue to rise, that these multiple locations that they probably own will continue to rise, and then that helps fuel economic growth. Obviously, that's not the case anymore. We saw in the July data, I can't remember how much house prices are down, but it's down. It's they've been down month after month for a while. So what will happen there? Well, you'll see a lot of these marginal developments either kind of coincidentally catch fire, or they'll be, destroyed, and that'll be counted in GDP as some sort of economic activity, and then they'll be built up at a higher standard at some point, and that'll be GDP additive, and so on and so forth, right? So the economic planning officials are incentivized on value add. So they will find a way to count these destructive activities into the value add for GDP. Keep in mind, Chinese officials or Chinese National Statistics Bureaus never revise previous data prints. Never. Okay. So that's really convenient. So, you always have a short-term memory. You forget what happened last quarter, right? And so if they had to go back to last year, 2 years ago, or 3 years ago and revise things down, they can forget all about that. And then they can have some of these activities GDP additive for the current quarter or the current year. So this is kind of the games that are played. And again, I want to make it clear, this is not just China. This happens in every country. Gaming the GDP calculation is done in every single country on earth. But real estate is core to China. you may have, say, merging of some of these companies, these sorts of things, because Country Garden and Evergrande have such massive debts. You may have to see some consolidation there and some real pain for those individual private sector companies, which will likely become public sector entities at some point, or ostensibly public sector, meaning the government will own, a massive amount of the equity in that company, but it'll still operate, like a private sector company, sort of, almost like what Japan's done with, with some of their companies.
Tony, to me, this real estate crisis, and especially the crisis within some of the big developers you've mentioned, Evergrande and Country Gardens, seems almost designed by the CCP in China via this 3 red lines policy implemented in August 2020. So do you agree with me that it is a crisis designed by the Politburo by the end of the day? And if so, where does it leave us in terms of hopes for a big stimulus package for the real estate sector?
Yeah, I don't think it's designed by them because it makes them look like like economic planning failures. So, of course, at the edges, some things may be designed, and certainly there's definitely been a lot of thinking about how to kind of deflate the real estate bubble and the real estate expectations. I can guarantee you that there have been tens of thousands of hours burned on trying to figure out how to steer this thing. But I don't necessarily think that kind of the crash has been intentionally designed. I think the reaction is probably what's been more designed, and how to kind of steer things down, because it's embarrassing. It's embarrassing for these high-level committees and mid-level bureaucrats and economic planners for this stuff to happen. So, nobody wants. So I'll give you an example. In July of 2015, when we saw Chinese stock markets crash, okay, it was literally a patriotic duty to buy shares even as markets were crashing. Okay. And we saw that in 2001 in the US when George Bush stood up and said, I'd invest in stock markets, all that stuff. So, but it's more of a core issue. And you had a lot of people who were bureaucrats and in state-owned companies who had lost 30 to 40 to 50% of their wealth in June of 2015, who felt obligated to continue to buy into markets because it was their patriotic duty to do that. And so, again, this is a very strange thing that most Westerners don't understand, that it is your patriotic duty to buy into falling markets as a Chinese bureaucrat, as a Chinese, say, party member, this sort of thing, okay? And when I say party member, I don't mean some kind of minion. The first time I spoke at the Central Communist Party school in Beijing, there were venture capitalists in the audience. Okay, so party members are across the economic spectrum, right? So it's their patriotic duty to buy, or was in June of 2015 to buy shares. It could at some point become a patriotic duty to buy properties to keep that market up. I'm sure there is pressure right now on people to do that indirectly, but at some point, once kind of the winners are chosen by, say, the Central Committee or the NDRC or whoever, there will likely be a patriotic duty to buy real estate among certain groups, okay, to prop up the value in certain areas or whatever. This sounds strange, but have you guys ever read this book called The Red Tsar? It's a history of Stalin, and it talks about how paranoid and fearful everyone was in the Soviet system. There is almost zero comprehension from Western analysts among how terrified Chinese bureaucrats are when they come into the office every day. Okay, so when I was working in the NDRC, and I always say this when I mention this, I was an advisor to the NDRC for a couple of years. I never collected any money in terms of compensation or expense reimbursement from the NDRC, so I've never been paid by the Chinese government. Okay, but I've been in meetings where Chinese officials have literally started crying. And so, there is terror within the Chinese bureaucracy. and this is not understood. So, Western analysts, Western economists have to understand this. There is no think tank writing about this. There's no journalist talking about this. This has been the way, for years. This is what I observed in 2015. Xi Jinping's power has consolidated even more since then. So I can't imagine the pressure on those bureaucrats right now, politically and bureaucratically, to align with whatever they need to do. And sometimes those, or many times, those kind of requirements are not verbally communicated. They're informally communicated, those expectations.
Just to follow up on that, what do you think that means for the transportation of information and the validity from which decisions are made?
Well, there's always, like in every political organization, there's always the official line, and then there's the unofficial communication, right? And so there is so much back channel communication within the Chinese government that by the time someone gets to a mid-level bureaucrat, they have to infer a lot from the communication. They really don't know what that communication is saying. Okay. So now imagine if you're a Chinese citizen, right? What you're getting is so many derivatives from what the original intended communication was. You're having to try to figure out how you need to act. Of course, there are the explicit, messages sent out, but there's so much inferred. And you can understand how things like the Cultural Revolution and other things happened when you're so many degrees from power, and that message may be amplified the further you get away from the center.
Yeah, I'm also thinking about how the bureaucracy works internally, and that is to say, if who wants to be the deliverer of bad news, so to speak? And
nobody.
Yeah,
nobody.
exactly.
And that's a great point. Nobody. Yeah. And when I say all of this, I need to stress that the people I knew in the Chinese bureaucracy were some of the smartest people I've ever known. Okay, these are not stupid people.
No.
These are very, very worldly, very, very intelligent people. Okay, so the Chinese government is not stupid, but the Chinese government also is not a monolith, right? So we hear Beijing said this, or Zhang Nanhai said that, or whatever. They can say that, but that's not exactly how the Chinese government is going to act. And so these guys are very smart in terms of, say, emotional intelligence. They're survivors, right? They've survived in the bureaucracy this long. They know kind of what is expected of them, right? If they believe it's time for them to cry in a meeting, then they start to cry in a meeting, right? They're also incredibly intelligent. The level of education that I saw with my interactions in China is incredible. So, these are very smart people, but the information we're seeing, the economic data we're seeing, very highly articulated. And again, very key to remember, those data are never revised. So the information you're seeing is information that you need to see right now. But in a month, it's dead. Nobody cares.
So, Tony, in times of crisis, where does this leave Western hopes for Chinese stimulus? We saw a package from China after 2008, a pretty big one, 4 trillion as far as I remember. Is something like that on the cards, or what's the most feasible outcome of all of this?
Yeah, it's a really good question. We've all been waiting for it. Okay. And I think right now we're in a position where these protests in December of 2022 were very embarrassing to the Central Committee, very embarrassing. And, whether or not we believed there would be a major stimulus, I think that the central government sees the economic need right now as an opportunity to exercise more power over the people and over the economy. Okay, so is there a big stimulus coming? Well, I think it all depends on who's going to align with what the central government wants more. Okay, so there is a race among the provincial leaders. There is a race among those core industries. There is a race among business leaders to show who can align with the Central Committee's desires the quickest. And those are the people who are going to get stimulus. Like, this is not just an agnostic kind of, hey, we want the Chinese people to succeed. This is very much a political game to see who can actually get those stimulus crumbs. And, we've seen crumbs spread here and there. Okay. I don't believe we're going to see massive high-speed rail investment, all that stuff. I mean, that's an old chestnut that's been revived since like 2005, right?
Yeah.
And so that's all played out. But there is a bias toward things like technology, but it's not the Jack Ma type of technology. It's more of a different era. So it is core chipsets, GPUs. It is in, say, energy technology and so on and so forth, right? And so those guys are, and anything kind of technology related that's export led, like EVs, that sort of thing, right? So those guys are going to get the stimulus because it makes the leadership look innovative. It makes them feel good. There may be some kickbacks here and there. Who knows, right? And so these are the guys. The stimulus process is a political process.
Yeah.
I'd like to conclude with, I don't know, the $1 million or $1 trillion question here, Tony. I think I've asked this exact question to at least 20 various portfolio managers based in either on US soil or European soil, and I've received a no from all of them. So with a 10 or maybe 20-year horizon, do you
shouldn't have told me that, because it makes me want to say yes.
I know that. But with a 10 or 20-year horizon, do you see any decent investment opportunities from a risk-reward perspective in China?
Oh, absolutely. Yes, I do. I do not believe that Xi Jinping will be in power by 2030. I believe that the next Chinese leader will be more of a moderate, because China is wealthier. And wealthier nations want more moderate leaders. They don't mind, giving lip service to communism or whatever, but they're wealthier. And I do believe that we will have another leader either by 2030 or in the 2030s who will be a more moderate leader who wants to, put this wolf warrior diplomacy nonsense aside and engage as a country among countries. And really wants to grow China's place in the world and grow China's economy in a very advanced way. Of course, there are huge pockets of China that are still poor, right?
Yeah.
So, that person needs to come forward and really, really move China forward. So yes, I believe there are and will be opportunities in China. They won't be what we had from, say, the mid 90s until, say, 2015. That was too easy, and that's gone. It will be more of a national or regional influential investment rather than a globalized investment, I believe. I think we've gone through that wave of globalization, the kind of second wave of globalization from, say, 2001 to 3 years ago. I think that's done. And I think the investment opportunities in China in the 2030s will be more either national or regional.
Tony Nash, CEO and founder of Complete Intelligence and former director of the Economist Intelligence Unit in Asia. Thank you very much for being with us to discuss China. It was a great pleasure to host you.
Thank you.
And we're back from the interview with Tony Nash.
Yeah.
I really love the way he managed to use anecdotal evidence from his time in Beijing to sort of stress his points here.
Yeah.
And it was an eye-opener to me how it's basically a duty to buy assets locally when those assets are in trouble. And I've kind of noted the pattern that whenever traded properties reached certain intervention zones in, for example, the Hang Seng Property Index, it seems like there is some kind of magic bottom, even though the outlook doesn't improve. So it might be that these sort of patriotic duties, they actually work
Yeah.
in practice. I don't know.
It's an odd mechanism, right? It's like paying tribute in a sense, right? Because generally, if you have a equilibrium price which is low and you just try to hamp it up, you're basically you're taking on a loss on yourself.
Yeah.
So, that's the exact opposite of what we're trying to do, right? Basically, So,
but Emil, before we move on to talk about our portfolio and discussions on how to play this market, I'd like to have a brief discussion on the prospects of a U.S. recession. We talked about the European recession initially in today's show, but what about the U.S.? And before we get to that discussion, Emil, let's play a soundbite from a favorite of this program.
Oh,
who
might that be?
The good old Mango Mussolini, Donald Trump, because he was not present at the primary debate earlier this week.
I thought you were about to say the BRICS summit.
Not there either. But Putin was not there either.
Would have been
and this is a highlight package of all of the nicknames he gave to Jeb Bush during the last primary.
Oh, I love it.
This is a guy who was a Democrat for most of the last decade. I don't think he represents the Republican Party.
He can't even put on a tie and jacket. He's running for president.
So he's doing this to inflame and to incite and to draw attention, which seems to be his organizing principle of his campaign.
This guy can't negotiate his way out of a paper bag.
And whether it's Donald Trump or Barack Obama, their rhetoric of divisiveness is wrong.
Very weak on immigration, wants to let people come in. Although now he is using Anchor Baby. Now because I used it, he's using it.
I appreciate the fact that Mr. Trump now has a plan, if that's what it's called.
Jeb Bush is a low energy person. For him to get things done is hard.
You win when you campaign like this. You don't win when you're campaigning like this.
No energy, Jeb. It's impossible to make a comeback from such a nickname.
Yeah, he completely wiped the floor with him, didn't he? I mean, it was embarrassing in the end. I mean, if you really were following it, I was.
Yeah. But I actually like Jeb a lot. But I mean, you're absolutely right. That he was just annihilated by Trump.
Completely.
The reason why I focus on U.S. politics in relation to this recession discussion is that it seems like the fiscal deficit sort of constantly ensures that the U.S. economy remains afloat, despite all of the risks from China, from Germany, wherever we talk about the recession risks.
Yeah.
We're not really talking about the recession risks in the U.S. right now, are we?
Not to the same extent, at least. I mean, obviously, that it's a recession that has been predicted and simply hasn't arrived. I basically put my heart out there to our customers, and I predicted that we will see a recession in Q1. And I think it's sort of an interesting dynamic here, which I know from emerging markets, and it's the one between, on one hand, you have the politicians and fiscal policy. On the other hand, you have a central bank with a mandate trying to enforce it. And in the US, we've seen a lot of COVID relief spending, and I did a deep dive into some of the packages that the treasuries are managing at this moment, and it was sort of an eye opener to see how, especially small business owners, are essentially incentivized to hoard labor. That's why we haven't seen that much firing and layoffs in the small medium enterprise sector, especially 50 employees and below.
Right.
And
and they employ quite a large percentage of the entire workforce, right?
Yeah, and it's sort of counterintuitive, because that's where you would think you would see the first signs of weakness, especially in the hiking cycle, where costs are imposed on each and every one. The ones with the strong balance sheets would usually have some leverage from which they can resist accommodating themselves, right? It's sort of, I think, and this is my own narrative here, but I think Jerome Powell has been cursing away the hill these past quarters for their just lackluster and the spending, and just they haven't really done much. Even the inflation
Production Act,
is a bit of a mockery, right? And now I think we will probably start to see some fiscal cuts, and they will come
on a sequential basis.
Yeah. And they will come. They will arrive right at a point where I think the U.S. economy will start to at least see some headwinds, and that's I think the negotiations from the coming debt ceiling negotiations will sort of enforce it.
So they will rein in spending when they need spending the most,
so to speak. But it's from high levels, right?
Yeah, sure.
So, but it's really ironic, and I think the interesting aspect is in emerging markets, that conflict that I just described, that's usually quite explicit. You would have like public stuff out, everyone commenting on one another, and the central banks usually just try to say nothing. And there's usually some governor who wants to keep his mandate and what have you, unless the stability and the institutional framework is not that strong. But in the US, they've been quiet, but it's just been going on behind the scenes, so to speak. I think that's the difference in my view.
Fair point, Emil. And let's see whether you're right that we will get an actual recession in Q1 next year. A lot of people took victory laps after the technical recession during the first half of last year, but it wasn't really a recession.
And just to be sure, I'm not predicting doom or the great financial crisis all over again or anything like that. I'm just saying I think we will see an increasing an acceleration in layoffs and more weakness in the labor market, and it will be a recession, but I suspect it will be a rather normal and ordinary one, to be honest.
The interesting thing here, Emil, is whether U.S. inflation will be at target during such, say, short-lived, such a short-lived recession. The indicators that we track kind of points to a bottom above 2% now.
Yeah.
So the one I like the most is the price plan survey from the exact same small and medium-sized companies that you referred to in relation to labor packages. And that survey typically leads sort of the median value of the CPI basket by 6 or 7 months.
Yeah.
And it points to a local bottom, at least in January next year, around, say, 3. Maybe just a tad below 3. So we're talking in core terms of inflation here. And then it reaccelerates.
Yeah.
So let's see. I'm much more certain that European inflation will drop below 2% than the USD, though.
100%. I think the major joker here is the impact from energy, which tends to run through in Europe to a different extent, at least also when we talk economics. But yeah, absolutely. We agree on that. Absolutely.
Emil, it's no secret that we've taken a couple of euro negative bets over the past week. So to set the scene, I found a hilarious interview with a guy on the street just after the Celtic Tiger evaporated post the 08-09 crisis in Ireland. So let's...
I'm Jason Calabrese with the Financial News, and today we're talking to a real Irishman and someone in the money business about what's going on in Ireland with the Celtic Tiger and the banks are hurting so much, the downfall. What's the story here?
Do you really want to know?
I'd love to know.
Well, I'll tell you, it's like what has happened all over the Western world for the last 20 or 30 years. Greed, and more fucking greed, and cheap money. And in Ireland, it's a tragedy what happened to the Tiger. We have, I'd say, 4 causes. We had a stupid fucking government. We had a regulator that was asleep at the wheel. And we had very deceitful and conniving and corrupt developers. And of course, above all, wanking fucking bankers. Wanking bankers. You have these arseholes for the last 20, 30 years are getting these massive bonuses, these employees and directors of banks, on the misfortune of the working class, and getting these huge bonuses and salaries. But, if you and all these arseholes should be thrown in jail and the keys thrown away for the rest of their life. And sir, if you went in and you're unemployed and you wanted to take a loaf of bread out of a store or a supermarket to feed your family, guess what? you'll be up in court for it. These assholes are living all over the world now on the backs of the misfortunate working people. And who's going to pay for all this? We've mortgaged the next generation or two. Who's going to pay for it? The working men. We got the labourer, the small farmer, the fisherman, the nurse, the teacher, the policeman, the fireman, the plumber, the carpenter. Fuck's sake, man! This is a joke.
So I'm sensing a
angry
little bit of
guy,
discontent.
but telling truths.
Yeah, I have some sympathy for his position. Yeah, to be honest.
Yeah, to a certain extent.
You're the ex-banker.
Yeah. No longer a wanger.
No.
Or sorry, no longer a banger. I'm still a wanger. But you gotta love the Irish action.
Yeah.
Throw the throw the keys away.
Yeah.
Love it. Emil, back to the portfolio discussion. We've taken a couple of bets against Europe, so to speak.
Yeah.
Both in currency terms, but we're also looking into, I'd say, various sectors vulnerable to this European lack of growth.
Yeah.
So a few highlights from our portfolio. Where do you want to start? I mean, the euro negativity is maybe the best way to start.
Yeah. Or perhaps now that we come from an Irish interview, perhaps we should move to London. We went short the cable.
Yeah.
And I think, I don't know, did you look into the details of the hard data coming out of Britain this week? It was absolutely atrocious, shocking.
Yeah. Also the PMIs were
PMIs as well.
Yeah.
I'm sort of a bit on the fence when it comes to PMIs, since they're not that reliable. But on the other hand, if you look at hard data from Britain, it's also, I mean, retail sales back down 20% year on year, stuff like that.
And even if you look at it in volume terms,
exactly.
Yeah.
And that real estate market just looks like a bomb just waiting to explode.
Ooh.
So that one. And generally speaking, I think just about all the positions we're looking into at the moment are either implicitly or explicitly just euro negative, right? That's where we sort of focused here. But do you have anything to add?
Yeah, we made an attempt just before summer to turn really negative on Europe.
Yeah.
It was a tad too early, admittedly.
Yeah.
I think we're there now. But I also like to express views in RV terms. And I think the best relative value right now is found in the space between Europe and Asia. And my point here is that Asia has taken a massive beating over the past, say, 6-8 weeks due to this Chinese real estate turmoil, while we've seen relative stability in European markets meanwhile. And given the discussion we had initially, I mean, it's impossible for Europe not to catch a cold if China sneezes. I hate that saying, by the way, but it's relevant for this discussion because Europe is, on a relative basis, just too interconnected with the Chinese economy to not care about what's ongoing out there. And I've been surprised by the resilience in euro assets through this Chinese crisis. And now that we see the signs of Chinese data spilling over to Europe, also given positioning that we see across both equity markets and FX markets, I think it makes sense to be relative short euro assets versus long Asian assets, because the sentiment is so bombed out in Asian assets relative to Europe, and they're essentially ultimately the same case to a certain extent.
And you will be entering on the back of like really bullish flows into the Europe, right?
Yeah.
So there will be a lot to unwind if things really start getting going. So I'm on that bandwagon myself. So
so
we've been trading that one.
Yeah. We've entered a short in the euro versus the Korean won.
Yeah.
There are lots of proxy expressions of this view. You can also proxy trade it in equity space, maybe also in fixed income space. Nevertheless, Emil, I think we will leave it at that for this week. For some reason, we always end up being skeptical around our own region here.
The grumpy old man on their own home soil here.
Exactly. So let's see whether we succeed. So far, we're in the money on these trades.
Yeah.
So far, so good. Emil Müller, always a pleasure.
Cheers.
Or should I say butthead?
Go on, Beavis.
We'll see you again next Sunday. Remember that this is just a window into our World of Research at Steno Research if you're interested in receiving the plenty of articles during the week. If you're interested in watching our live portfolio, etc., you can find it at stenoresearch.com, and we have the exclusive offer for the audience of Macro Sunday. Macro 30, Macro 30 will provide you with 30% off your subscription. We'll leave the link and the coupon code in the show notes. Thank you very much for watching this week, and remember, as a broad disclaimer for this program, our trade ideas might be
Sometimes may be good, sometimes may be shit.
See you next Sunday.
Sometimes may be good, sometimes may be shit.